I want to start off with your view, actually. It's a pretty interesting one, that the returns from the public markets over the next decade, they're going to be about half what they were the previous decade. You think over the next decade, it's going to be about 5 to 7%, previous decade about 12%. How does AI, how does that help an investor manage this decline in returns from the market?
Well, I think the good news is that most investors have already benefited in a very significant way from what's going on with AI. If you look at indexes like the Morningstar US Market Index, they've really been powered by the returns of AI stocks, as you know, the Magnificent Seven and beyond. And so returns have been very significant to the tune of north of 10% annualized over the past decade, which by any historical measure is a wonderful outcome. And so when we look ahead, we expect those returns to moderate and maybe come down, closer to the 5 to 7% annualized rate of return. Now, it's not a comment on AI and the power of AI. I think it's just a comment from us in terms of how we feel about the prospective returns, given that so much of them have already been captured going forward. In fact, if you look at our total U.S. market forecast, we think the U.S. market is largely fairly valued today, maybe even slightly to the overvalued side. However, there's great returns and opportunities in value stocks, small cap stocks. So there's certainly opportunities over and above, the headlines.
Okay. You're seeing a lot of opportunities. I think a lot of people see the opportunities, but you thinking it's fairly valued. I think that's a bit of a contrarian take. I think a lot of people call it frothy, foamy, whatever the word you want to use is. One thing I'm sure that a lot of your investment advisors are hearing from their clients, they're getting calls about the impact of the election on the markets and their portfolios. When we look at that, are we overstating the possible impact, understating, getting it just right in your mind?
Yeah, for most investors, I hate to break the news, it's good sport, but ignore it when it comes to your portfolios. I'm a long-term investor. We believe in long-term investing. And candidly, if you go back to the history of U.S. markets, investors have done well just to focus on their end goals and remember that no matter what happens politically, have your goals in place and basically build your portfolio and stick with it for the long run. And that's a good strategy, and that's what we believe makes sense.
All right. Also, we have the Fed meeting kicking off today, the Jay Powell press conference tomorrow. No cuts, no moves expected this time, but a lot of expectations for a cut coming up in September. Is there still time, if you're an investor, to position your portfolio, or all these moves, the idea that we're getting that cut coming up in September, is that already priced in your mind?
Yeah, I mean, it seems like it is. Markets are historically fairly efficient, and so I wouldn't try to bet against the efficiency of markets. I think what's important for investors is maybe thinking about how they might need to rebalance their portfolios if they've not already. And so I think moments like this are a good reminder. If you have maybe moved your allocation between stocks and bonds one way or the other too heavily, take the time to rebalance and make sure your goals are exactly where they need to be. And I think particularly when you look at what's happened, equities have run ahead. Just make sure the fixed income part of your portfolio makes sense and is the allocation you want, because certainly yields are attractive. And from a total return perspective, I would not discount fixed income. All
right. So I know you're a long-term investor. I want to talk to you about something that's been more of a near-term trend, just the real intersection between the public and the private markets and investors looking to get more exposure to those private markets. Now, you believe that interval funds are one way to get into the private markets and kind of find that intersection. But I want to ask, why right now? I mean, the equity markets, some volatility recently, but are having a really strong year. Why are you so bullish on the idea that people need to get into interval funds or find some access to the private markets right now?
Yeah, I wouldn't say I'm bullish on doing that. I'm just, I think it's the reality where we find ourselves today. We have so many companies going private, more than 100 annually for a few years now. And if you look at the trend, companies are staying private for more than a decade. It used to be more like 7 years, but according to our PitchBook data, that has changed very materially. So if you're an investor, you're potentially not getting exposure to a whole chunk of companies. And so over time, we think it'll be natural that individual investors, advisors will start getting access to these markets. And obviously not everyone is a qualified investor where they can go and get in a PE fund. And so you're starting to see the rise of instruments like interval funds begin to provide access, for example, to private fixed income. You have a partnership being announced, for example, between Capital Group and KKR. And so it's less about being bullish and more about thinking about the future in terms of how an investor gets access to the whole plethora of companies and the equity and debt associated with those companies, and the reality that more and more of that will come from the private side of the ledger.